Now let's address what's happening with Happiest Minds, and we've got Venkatraman Narayanan, the MD and CFO at the company, joining in on the show right now. Venkat, hi, morning. Good to have you on the show. To begin with, Venkat, can you explain the rationale of the stake sale by Mr. Soota just yesterday? Also, will there be any more such pairing of stake?
Good morning. Let me cover the point on the stake sale. When we recast the vision for the company about 3 years back post IPO, we said that we are designing and building a company for perpetuity. And one of the key conditions, or one of the key things that was to be done at that point in time, is to make sure that the controlling stakeholder of the promoter is protected at somewhere around 40%. That's been made public. Subsequently, we have also said that Mr. Soota is engaged in doing the non-profit activities of his through an organization called SCAN, and he has been contributing a substantial part of his wealth and his earnings towards that. He's also having another company called Happiest Health, which is associated with health and wellness, primarily which got him started, which is something that he started after COVID. So with all of this, he has been saying this consistently, that he would be, paring down his stake to make sure that the contributions happen towards his legacy building. And the base level was something at 40% that he had set. Right now, he's at 44.3% holding in the company, well within that stated objective and limit. There is also, he has been meeting certain fund flow requirements for his objectives of non-profit requirements through a pledge. And I'm sure he'll have that removed once the proceeds of the sale comes through into his account. So this is all as per disclosures made and in line with what we have planned for the company.
So you're saying there is further headroom for him to pare down stake? A little bit though.
Not immediately because, he has raised a substantial amount, and this has to be applied for the good that he is doing right now through SCAN and Happiest Health. And at a later point in time, he has got dividend streams and other income as well to apply. So he is best suited to answer that, but as of now, there are no immediate plans. I can say that much.
Very important clarification which you have made. That this is 800 crore or thereabout raised for philanthropic and non-profit work, as stated earlier. So nothing great change in the strategy. Let's come back and talk about the operational part of the story. You have maintained that $1 billion in revenue by 31 is the target. The entire industry has become very challenged. Some companies, such as high growth companies such as yours, of course, are doing a good job. But the growth from here on, what percentage of that growth or your movement between now and $1 billion revenue will come on the back of buyouts, and how much will it be organic?
So just to put the numbers in perspective, from today to 2031, the company has to grow at a CAGR of around 22% and thereabouts. Last year we did 11.5% in a challenging market. This year, including the acquisitions, our estimate is that we will do something between 35 to 40% and thereabouts. So if you look at it, and I'm giving it as an estimate because, when you do acquisitions, there are cutoffs for how many months of revenues you can take during the cutoff period, the closing date and all of that. We have closed both acquisitions. But nevertheless, we have set out that estimate of about 35 to 40%. So this year, our acquisition plus organic growth, the strong organic growth, we did 11.3% last year. This year we are hopeful of doing something similar or higher, along with acquisitions, puts us in the range of 35 to 40, and on an average basis is getting us, back to the 22% mark and that $1 billion rate. From here, you will have to essentially again build on the base of the organic muscle that we have, and we will also have to add on a couple of acquisitions as we, navigate this growth towards 2031 and $1 billion dream. So that's where we are.
So then when it comes to the margin picture, can you give us a sense as to what it is that you're looking at? They're estimated to be in the range of 20 to 22%. Are you holding on to that estimation, and what would be margin drivers?
Yeah, we are holding on to that estimate. Again, In the year of acquisition, you have acquisition costs. While you do get benefits of acquisition, it takes some time to flow through into the P&L. But there are certain investments that you need to make upfront. So, including those acquisition costs and the cost of integration, I've given a margin guidance of about 20 to 22%, and we are hopeful of doing better. There are two elements to it as well. One is the companies that we have purchased are profitable, and they are at a relatively similar margin profile as us on the operating side. But we also had a healthy other income the last year because we had raised capital. That was on my books for quite a period of time. That got me about 81 crores of other income last year. I still am sitting on a reasonable amount of cash reserves, 700 crores of rupees, but nothing, it's not as much as 1,300 that we had last year. So that adjustment also needs to be made while you do the margin. From an operating margin standpoint, we are hopeful and we want to target between 20 to 22%. When I say operating margin, essentially I'm talking about EBITDA without the other income. It should be between the 20 to 22%.
When you say that you're confident of increasing your margins as well, what exactly are the levers for margin improvement which you are applying?
So last year we did a utilization of about 76.5%. If you look at our history, our utilization has been between 79 to 81%. That was the range. While 81 is a very high, 79 is a healthy one. So 76.5 to 79, you have a headroom. Second is attrition rates were higher in the past. Attrition requires you to replace people at a higher cost, and attrition rates today are at about 12% TTM, which means your cost is coming down. Third is we have been working on our pyramid. We onboarded close to 600. Unlike other companies, we went ahead and made the commitment with the bullets, got them on, and they are going through the training period, and within the next 3 to 6 months, they should hit the billable workforce, as we call them, happiest minds billable workforce, which means they are revenue generating, even though at a lower utilization compared to almost zero in the last year. So that also helps in getting your average cost down while also moving utilization and the efficiency up. So these are the few points that are growing in our favor. Then we have the other things of we haven't seen much of price pushback from our customers, so that's a relief for us. And it may be because we do not do cost plus, we do market or demand based pricing, which is something in discussion with customers, so we don't get price pushback. The second aspect is, there is a repeat sale. We do about 90% of my business comes from repeat business, which also has its impact on, margins. So with all of this, the levers on margins are there for us to, play on or rather optimize on, which is what gives me some bit of confidence.
You created Gen AI business unit. Can you just tell us a little bit more about the long-term vision here?
See, we have created a Gen AI business as a business unit, which means it's not like a COE kind of a structure, which many of the other companies have done, which is fine. But from our side, we think we have to put it right in the front of the customer, and both the customer and the markets have to see the investments that we make. So which is again going in line with the transparency of what we do. So we have made it a BU. The moment you make it a BU, we'll have to report separate numbers right up to the margin. So that's what we want to do. Maybe it will happen this quarter, the next quarter we'll start carving out the business and its results up to a BU level, just like what we do for the PDS and IMSS right now. So we have carved it out as a separate BU, and we hope that it will contribute at least 10% of our total revenue. Because if you look at it, IMSS is about 18-20% today, PDES is about 80%. So if a BU has to stand on its own merits and have its own business structure and all the things that go around with that, you have to be 5 to 10% within a reasonable time frame, which is about, let's say, 2 to 3 years. It has to be there. You have to also look at it from the overall size of our business. We are about 200 million exit run rate last year. This year, right now with the acquisitions, we are about 250 million, nearabouts, or in terms of run rate. And if you're talking about 5 to 10%, that gives you a fair understanding of what we are seeing as a possibility for this BU over a period of 2 to 3 years.
Have you on board. Thank you so much for joining in and sharing with us your financial metrics as well as the long-term road ahead. We'll take a very short break. Don't go anywhere.